retail in a very specific way over the next little bit here, and it's really mall-centric. So to the extent you guys are interested in malls, this will hopefully be a little bit enlightening. Pacific Retail was born out of kind of the beginnings of the recession back in 2008 when I broke off from Samara Capital, which was a group that was involved in buying, acting as an operating partner for various funds in the mall space, and it had been doing that for about 8 years, and we were fairly successful at it. But we came up with this tagline of standing still is not an option back in '09, because at the time everybody was kind of like a deer in the headlights. You know, money was going into a bunker mentality, and people were literally freezing and they didn't know what to do. And it was a very scary time in the financial world, and it was a really scary time in the retail world. And what we tried to do as an operating partner is let people know that there are options, that people were still shopping, and there are certain things that you could do to really go out there and get people enticed to open up some very tight purse strings. And this tagline has kind of stayed the same because it's really kind of our mantra that you have to be proactive. I mean, retail is a product type. I mean, you all are studying real estate that's just different. It's something that's got a lot of layers to it. It's, I think, much more complicated than a lot of the other product types from office and industrial and multifamily. Nothing against those. I mean, they all fit. But retail takes into account a lot of disciplines. It's got what's going on in the consumer market. You know, how good does the consumer feel about shopping? I mean, where do they feel like going to be aspirational? What do they want to buy, et cetera. As well as what's going on with the trends in the retailing industry. A lot of finance goes into all this, and also what's happening with design trends. And so we're going to talk a little bit about kind of all those pieces. This is kind of a pitch book that we put together a while ago, so it's not a shameless plug on Pacific Retail by any stretch, but you'll see a few commentaries about how we pitch business. We look to co-invest. We are an operating partner. So what that means is we act as a soldier for the money. So we are out there working with the groups like KKR, Square Mile, which is a hedge fund, JP Morgan and the like, where we act as kind of the day-to-day responsibility for these investments. We have dollars invested alongside them, so we have alignment. But the big guys like KKR, they represent generally most of the money. These assets are big assets. I mean, a small regional mall is $100 million, and they can go up to $1 billion. So there are a lot of tenants, there's a lot of dollars involved, and when there's a lot of dollars involved, there's a lot of attention paid to these things. So let's start off a little bit and just kind of like look at what's going on in the current retail environment, and we'll look at a few things from the economic trends, product trends, consumer trends, and retail real estate trends. And one thing about mall land is it is constantly morphing. Retail is constantly morphing. I mean, you all shop. I mean, you see how consumer trends change, how retail trends change. And the thing that we strive to do in our business is to remain relevant. You can't stand still. You have to stay on top of what's going on in these various trends. Right now, you've got the new normal of somewhere around 2% GDP growth. I mean, that has profound implications to the shopping world. And disposable income growth are all really low compared to historical trends. Job growth is going up and down. It's averaging about 175,000 a month. Income growth is going to be dented significantly by the increases in taxes this year on a federal level and state level, especially if you live in California. Consumer confidence is better. Savings rates are still pretty below long-term averages, but they're better than they were in the mid 2000s. The fiscal austerity is going to weigh on sales, I think, for some time to come. Both the high end and the low end are getting affected right now, especially with the fiscal austerity. But the high end mall NOI, the net operating income growth, is doing pretty well. I mean, the rich are getting richer and they're spending it. The big thing that's changed is the financing markets over the past few years. I mean, they are very, very healthy. I mean, interest rates now are below 4%. I mean, you can get CMBS debt that's 3.5% for fixed 5 to 7 year terms, and some of that's interest only. That's very compelling. It makes a lot of pro formas work. The other big thing that is kind of unique in at least my career of doing this for 30 years is there's no construction going on the commercial side. There's apartments, there's housing, but there's no retail. There's no office. There's no industrial getting built right now. The country overall has been oversupplied for decades, and I think there's like 42 square feet per person in the United States, which is about probably 20 feet per person too much. And the fact that there's that absorption going on and a chance for redevelopment to occur is good for the business. With product trends, kind of the big thing that you'll hear more about is mass class, which is really moving quality and value down the price slope. Now, mass class can be Forever 21, or it could be H&M, where you have fast fashion that's in a great environment and it offers some really good value. Tiffany's is an example of a mass class retailer, we feel, because everybody loves a blue box. I mean, whether it's a $100 gift from Tiffany's or somebody can afford $1 million diamond necklace, but it appeals to a really broad-based consumer. Luxury goods, as I mentioned, they continue to lead the market. I mean, the rich are spending. But there's a lot of interesting new places to shop, eat, and socialize. XXI, Love Culture, if you haven't seen one of those, it's a knockoff of Forever 21. Great concept, very fun. H&M, Sephora, Whole Foods, which has become kind of a hangout destination in and of itself. A ton of new restaurant concepts. I mean, I get asked often about when does a project have enough food or restaurant opportunity in it, and the answer is never. I mean, as long as you can keep leasing to the restaurant guys, they seem to create some pretty good synergy. So the more you add, the better it seems to do. Theaters are a huge add to the mix of the mall process now. They add kind of that entertainment feature, which is a big bolt-on component that is new to malls. In fact, the thing about malls is they're no longer just this kind of big, huge, giant box that sits on 100 acres and fairly brutalist architecture with 25% lot coverage. What you have now is you have elements of a lot of different retail types bolting on to the mall. You've got lifestyle pieces, which can be entertainment, it can be some big boxes, you can have restaurants. We close on an asset tomorrow in Albany with KKR, which is a mall called Colony Center, which was built back in the late 70s, I think early 80s, and it was just a typical 3-anchor mall that had Macy's, Sears, and Boscov's. A group came in, bought it for $100 million, and then they put another $100 million into it. Unfortunately, they borrowed most of that money in the late 2000s, and it went back to the bank, and we bought it back from the bank at half the cost they had into it. But what they did is they put a theater on the third level. They put restaurants on the exterior, Cheesecake Factory, P.F. Chang's. They have an LL Bean. They have a, who's the other guy? Whole Foods is coming in as well, all facing the front. So now you have this very interesting and kind of inviting frontage to the property, which makes it different, and it broadens your consumer base. So that's really important trend that's going on in mall world. Not everybody's doing that. I think people like Macerich have done it pretty well. Westfield has done it pretty well. Guys like Simon and GGP are kind of late to the party, and they seem to be doing it much more slowly. There's still very much survival of the fittest out there. There's a lot of old concepts that are just not making it. The department stores, if you followed any of the stuff on JCPenney, they're trying, and it's very hard for them to write a battleship and turn a battleship around. the jury's out. We'll see what happens. They've got a lot of work to do. Sears, people have been predicting the demise of Sears for decades, and they still keep hanging on. And I think their saving grace is the fact that these guys own 2,000 stores. They own the real estate. Penny's has about 1,100 stores, and about a third of those are owned real estate. So that's a good cushion for them, so I wouldn't necessarily count them out. There's definitely an opening in the market for new concepts. I mean, that's one thing that is very self-evident. Consumers are constantly looking for something new, and one of the things that we're going to see more of are some of the overseas retailers like Topshop. Uniqlo is coming over here from Japan, and Uniqlo is going to start opening a lot of stores. You're going to see them dot the landscape pretty significantly in the next few years. So the consumer trends, they're still spending, and it's moderated. It'll probably maintain in the 3% year-over-year growth rate range over the next couple, 3 years. Again, high-end shoppers are wealthier than ever, and they're a sizable demand driver. There are some big negative changes in that people are pressed for dollars, so the average length of stay at a mall has dropped considerably. It used to be over an hour, and now it's around, I think, 43, 44 minutes. So people are doing very targeted shopping. They're going in, they know what they want, and they're going there, they're buying, and they're not doing a lot of cross-shopping. So you have to have something that's really going to pull a shopper out of their targeted kind of focus to, get them to cross-shop. People are, I think, kind of sick of the same old, same old. People are getting more sophisticated to shopping, so they're looking for stuff that's more unique. This idea of kind of creating the sense of discovery is pretty true. I mean, people are looking for a unique characteristics. They're not looking necessarily for the same Gap store, the same New York company store, or the same Express store. They do like some of the good local stuff, and the major REITs have been very bad at kind of not allowing the local flavor into malls. They've been good at kind of shutting those guys out. I think what we're starting to see again is that there's a lot of interest in having a broader mix, so nationals as well as some good regional guys and even some good local guys. The local flavor can really come from the food, from the eating establishments. And then there's the area of kind of new design. And to the extent any of you do want to get into this avenue of real estate, one thing I would encourage you to do is take a design course, take a basic design course. So when you sit down with your architect, you're not going, I like blue, because it's, if you're a guy, you tend to like blue. And you go, I like that color, and that's not necessarily the colors or the look that you want. Please.
In the same vein of design, what's your viewpoint on the closed malls versus the open air lifestyle centers, and kind of where you see that trend going?
I think there's a good hybrid occurring. What we see happen over and over again is that you've got this huge country, and one of the things I love about this business is you get to see the different cultures of the United States. So what works in LA doesn't work in Houston, doesn't work in Chicago or Seattle or New York for that matter. So you have to kind of figure out what does work, and climate is a big, it's kind of like a duh, but I mean that's really what you have to think about. So an open air center in Chicago, Oak Brook Center in Chicago does almost $700 a square foot, which is phenomenal, and it kind of defies tradition. But people also want a enclosed place to go. So can you have both? And we think the answer is yes, and it's creating maybe kind of a lifestyle component. So on those nice days when you do want to go outside, or you want to have be at a restaurant that has a nice patio and you can enjoy a fountain in the plaza area, yeah, that's terrific, have that. but also have the ability to go inside on a super hot day or it's a super cold day and have that kind of nice interior environment. So kind of the blending of both is really where I think the retail design trends are moving to. Please.
What are some of the common denominators in projects where you saw multi-story retail work effectively in the U.S.?
In New York?
In the U.S.
Oh, in the U.S.? Multi-story is tough. I mean, one level works much better than multi-level, unless you're in a major metro. And then 2 levels is about all you can get people to go up. You know, beyond that, it has to be a super urban environment. And even then, San Francisco, New York City, a little bit in Chicago are about the only 3 cities in the U.S. that really have had multi-story retail work beyond the 2nd floor. They've tried it. It's cost billions of dollars and blown up projects where it hasn't worked. But it's tough to be able to get a consumer off the ground floor and up. If any of you have been to San Francisco Center, that's a project owned by Forest City and Westfield. That's 7 floors. Terrific project. I mean, they spent a fortune on spiral escalators that go up to Nordstrom, which anchors it up on the higher levels. I mean, they really had to do some very smart thinking out of the box, and they were able to achieve that. But it's not very few places that you can really achieve that.
You were talking about local flavor, and a few years ago there was an outcry as many of the regional department stores were taken over by Macy's, Montgomery Ward, Dines, and Riches, and the like. I'm curious, one, in your opinion of that and how it impacts the regional malls, and also its impact on sales per square foot and lease rates, and are customers responding to now then these stores being Macy's, or you sense that maybe they've lost a little bit of that customer base because they may have had their bigger affinity towards these regional department stores?
No, it's a great question, and the short answer is absolutely it's affected the overall productivity of the malls, and most importantly, it's affected the productivity of the department stores. I mean, I think there was a lot of arrogance and hubris around Macy's coming in and taking over Bloomingdale's, for example, which had an incredibly loyal shopper base, and they just kind of said, we're Macy's, we're from New York, the consumer will get used to us. Well, what happened is the consumer just stopped going. And as we look at properties around the country, you can see it. You can see some of the sales productivity from, early 2000s to today, and in general, those stores have just declined in productivity. And that obviously affects the overall inline sales productivity of the mall, because if you're not driving sales at the department stores, it's tough to rekindle that within the inline and the mall. So it's been bad for the business in that we're now down to just a handful of really realistic anchors to a mall now. I mean, you have Macy's, Sears, Penney's, and then Target and Kohl's. I mean, if we have our druthers, kind of our favorite lineup is to see a Macy's and a Target. I mean, those are terrific to have that lineup. And then maybe a Kohl's, and we still like Sears. I mean, Sears is basically a glorified hardware store. You've got, it really is. That's what it is. I mean, not that many people go for the softer side of Sears. I mean, they just don't do it. But it's still a good offering for a community, and we like to see that sort of kind of piece of the puzzle. But it's tough because it's the biggest kind of loss has been to the consumer because they don't have that differentiation. We'll get into a case study that we did. We bought a property last year with KKR in Chicago called Yorktown Mall, and that's got 2 kind of, I'll call them not really national guys. One's Von Maur. If you live in the Midwest, you'd know Von Maur, and the other one is Carson Perry Scott, and a little bit better known, a little bit larger. But those 2 department stores represent, I think, a nice differentiation from the Macy's and the like. And they're unique and they're highly productive. I mean, the sales volumes out of some of these stores are huge. So as far as what the real estate trends are, number one is maintain value. Is like, keep the NOI growing and be creative and figure out how you can do that from bringing in other uses, other unique box uses or lifestyle uses. And redevelopment is really the key right now. There's not construction going on, new construction, but people are looking at their assets and going, how can I unlock value? How can I look at freshening this up, making this more relevant, making this more something that's exciting for people to go to, someplace that people want to go spend some time and hang out, and have that be kind of the third place, outside of home and work. Where's that place that people want to kind of go and potentially hang out a little bit? Outlet space is probably the only thing that is growing right now. There's kind of outlet mania with the REITs right now. It'll be interesting to see when that bubble finally bursts. There's been some great occupancy gains and pricing power. At the higher end, the A malls have certainly kind of had some very strong NOI growth and very, very strong productivity growth. B mall is uneven, but it's getting better. There's a lot more malls that are selling right now. You have roughly 12 to 1,300 malls in the United States, and depending on your definition. And of that, 55% roughly are controlled by the major REITs. And the REITs have been, pretty dominating on their control of the flow. And up until the financial crisis, Wall Street and the analysts were saying, if you buy more, we're going to reward you because having more and more market share is good and will increase your share price. Now Wall Street and the analysts have realized that that's not really true, because the REITs, like every business out there, has limited manpower and it has limited amounts of capital. Even though equity's cheap right now and debt's even cheaper, it's still limited. So if you're Art Coppola at Macerich and you've got 62 malls, you don't have enough manpower, you don't have enough bench to put it on all 62 assets. And you don't have enough money to do the redevelopments that you want to do on all 62 assets. So what you do concentrate are on your top tier, your top half of the assets. And you have another half that are kind of languishing. I mean, you're keeping the lights on. And if you're David Simon and you have 350 assets, you really got a problem, because he's a pretty chief guy anyways. I didn't mean that, David. But I hope that never gets back to him. But anyways, you have to be very judicious on where you're going to spend that money. So what Wall Street's saying now is focus on your productive assets, make those assets really productive, make them fortress-like, grow that sales productivity as much as you can, and sell the stuff that's on the bottom half. And will reward you. So get smaller, not bigger. Get focused, not increase market share.
For those who are buying the leftover malls, though, how can they create value? Some of these C malls that are, let's say even the one here in Ithaca, which probably should never been built. How can you create value with those bad malls?
I'm gonna defer that, because that's kind of the rest of my topic here. There's a lot of ways to do that, and just to touch on that, and then if I don't answer that question, we'll come back to it. But if the REITs start selling just a few of these assets, for a group like myself, where we're an operating partner and these are big assets, we're not looking to buy a lot of these. I mean, we own 3 of these assets now. At one point, we had 12 of these. But if we get back up to 12 again, that's a very happy moment in my life, as well as everybody who's working for me. So we're good with that. So you don't have to own a lot of these. I mean, the wealth creation that can be made on a mall is pretty spectacular. I mean, the profitability on some of these goes from 50 to $100 million in a short period of time is just the profit potential. And there's very, very few asset classes outside of maybe midtown office buildings that you can create that kind of multiple on money. So you can find the needle in the haystack. It's taking a rifle shot approach. So if Capola at Macerich wants to sell 10 assets, there may be one or two that we really like that we feel that we can unlock value through a number of different ways.
How often will they actually cherry pick those one or two assets, though?
More often than you think. Right now, not to pick on Macerich, but they're active right now. They went to market with a portfolio of around 16 assets, and they would have loved to sold to one investor, and there were people that were willing to buy on a distressed basis. Art's not a distressed seller. He broke it up into different components. So some people got 2, some people got 4, so there's a number of different buyers for those. And of the groups that got a smaller percentage, there were a couple of decent ones in there that we feel anyways, you can make money on. So here's our investment model. I mean, we're looking for, as I kind of touched on a few of these things, they're either underperforming or they're capital deprived, and we try to, in a way, try to be kind of, many times, be a REIT repair shop. So we'll buy from the REIT, we'll bring in dollars, we'll bring in focus, and we'll really work these assets and try to unlock some value. We're looking at these non-core assets, or they have suboptimal investment structures, such as the one we're buying in Albany right now, where it was taken back by Hypo Bank, and they've been in basically a maturity default since '09 with cash flow sweeps every month, so there's no dollars to go really reinvest in the property. But to start answering some of your questions on how do you make money, is you reposition these in such a way is you try to connect with the communities. I mean, the one size fits all, as I mentioned, doesn't work anymore. And one of the simplest thing we find to do is find out who the hell your shopper is. I mean, what do the people want? You go into a trade area, each trade area is different. We tend to do a lot of research right after, during due diligence and after due diligence to really figure out what our consumer wants to have. I mean, you have typically, our kind of rule of thumb is you have at least 250,000 within a primary trade area, and those 250,000 people like to shop. I mean, it's a necessity as well as something that hopefully is fun for them to do. They don't like to have a situation like here in Ithaca where you have a crappy mall that people go, why is this even here? I don't want to go here. I'd go anywhere but here. And what you're trying to do is say, okay, what do you want? What tenants do you want? Who's missing? We're looking at void analysis, trying to figure out, what tenants aren't in the marketplace or could be in the marketplace. And we want to make sure that we have the appropriate makeover strategy. So, I get back to kind of the design piece of it. We work a lot with Gensler. Gensler's largest architectural firm in the world, and they have a great retail practice. But they're smart in that they don't say, hey, being based in LA or being based in New York City, we're going to drop this sort of design characteristic onto Chicago or Houston or Seattle, because it probably won't work. We're going to figure out an aesthetic that is appropriate for the community. So you don't necessarily want to do something that's kind of too over the top, and what may be, from an LA or New York perspective, be somewhat trite, may be a big deal for the community that we're going into. And it could be as simple as putting in a play area, putting in a really nice food court, having it really clean, doing something to the facade that brightens it, makes it a little more contemporary than it was in 1970 when the mall was built. We try to get a really good best-in-class team. And when we say best-in-class, we're trying to get people that are really good at this business. in their respective field. So it's the best designers and architects. It's the best construction guy. It's the best leasing guys we can find for that particular area. We're trying to get the best security guys, the best maintenance guys. I mean, we want to make sure that we have a team that is appropriate for the marketplace, appropriate for kind of our strategy. And we're not looking to necessarily go into a project and say, well, we've got a $100 million renovation budget. I mean, our renovation budgets are probably closer to $10 to $20 million as opposed to some of the big dollars that you see out of some of the big redos. And we're going to operate the property on a very focused basis because our goal is to maximize cash flow. We want to make money. And at the end of the day, we're trying to take a product that's a B plus, maybe an A minus, well, B plus asset, and turn it into an A minus asset. It doesn't necessarily have to be an A. So your question of how do you create value? You look at a few things. I mean, these are all strategies that you're going to mix and match, but they all kind of prove effective. You're going to look at reconfiguring, expanding, or even contracting some of the physical layout. You're going to look at operational inefficiencies. We're amazed how you can go in and look at the security, where a group may have had internal security, and you third-party that out to a very good operator within Chicago, a property we bought last year. And we were able to get better security at a fraction of the cost that we had before. So you look at inefficiencies like that. Make it look nicer. I mean, simple, but you'd be surprised how people miss that. Lease up vacant space. I mean, we try to take a realistic approach to leasing up vacant space. Leasing is hard. Leasing is a really tough business. It is the engine that drives value, though. And we try to look at a pro forma that says we're going to lease up space in a thoughtful manner. When we get to the case study, I'll show you what I mean by that, but you'll be, as you go out into your careers, I caution you when you're in the retail to really question your analyst review of how they're leasing up space. It's tough to do it. And when you have a big asset, it's even harder, and it takes a long time to do it. We always pro forma the first year, we're hardly going to do anything because we're kind of figuring it out. We're trying to figure out what we're going to do the first year, what our strategy is going to do. I mean, it sounds good on paper, but reality tends to be a little bit different. And then we start ramping it up over time. Again, adding shopping districts, re-merchandising, looking at the entertainment pieces. Look for underutilized land. As I mentioned, I mean, most of the bigger, or the average size mall of 1 million to 1.5 million square feet is roughly 100 acres of land. It's only got 25% lot coverage. That's a lot of parking lot out there. And we look at ways, how can we add residential? Can we add a hotel? Can we add other stuff to that? And it may even, if it's an urban enough location, we may look at being able to parcel some of it off. And then the big thing right now is adaptive reuse of obsolete space, i.e. department store buildings. I mean, there's a lot of empty department stores out there. We've been trying to be very creative. There's no magic fix on that. If somebody can figure that out, they're going to make a lot of money doing it. But we just signed a lease on a property we have in Houston today on a vacant JCPenney building, which is a 2-level, 100,000 square foot building. Penny's new prototype is 106,000 feet on one level. They don't want 2 levels. So we had 50,000 feet on each floor. When we bought this property, we figured we'd never lease the second floor. I mean, how the hell are you going to get somebody to go up on the second floor, especially in Houston? And we just leased it to a college. So a technical college is taking the whole 50,000 square feet. I mean, go figure. But it's that sort of thinking that you have to be creative on some of these bigger spaces. And then, our goal is not to own these more than probably 5 years. I mean, it takes 3 years to really implement a repositioning, and then you want to stabilize it a little bit. This slide really, I think, for the business I'm in, this is the reward slide. there's an absolute correlation in the market between inline sales productivity, which is the productivity of those tenants under 10,000 square feet, and sales price, which is basically a cap rate. And the higher the productivity, the lower the cap rate. And this is based on, if anybody knows East Still Secured, I mean, they're one of the leading brokerage firms out there, especially in mall space. And you can see that if you're down below $300 a square foot right now, there really isn't a cap rate. It's a return on cost because you're figuring out something else to do with that mall. But as you get above $300 a square foot and up into the holy land of over $450 a square foot, that cap rate drops like a rock. And if you're up in the super productive fortress malls, which are up over $450 or $550 a square foot, that cap rate's down around 4.5% to 5% right now, and that's a very lofty value. So that's the goal, is to increase productivity, and you can do that in a number of different ways. So this is. We're going to skip through some of this. We talked about this. This is our pitch. But what do we try to do? We try to make it more customer friendly. We try to go from the product centric to really the customer centric, and we try to do that with the retailers by having the retailers have kind of an open and friendly persona when they're greeting customers. It's not just a house of merchants, it's really an entertainment center for the customer. We're trying to reach out to the community. We're trying to have links that bond with the local elementary, the high school, with the community groups around there. We want to basically be a good integrated part of the trade area, and we want to knit within that community. And that's not just lip service. We actually spend a lot of time trying to do that. Our marketing people spend a lot of time reaching out to the communities and figuring out what we can do to make sure that it stays a viable part. I mean, one thing that we don't want to do is be seen as a magnet for crime. I mean, that's the kiss of death on these properties. We focus a lot on the children's programs. We're trying to create play areas that are not just melted plastic. They're actually interactive, they're fun, and it's a place where the moms and families can come.
What's your opinion on mall, like branding, like Westfield, the shopping towns?
I don't think it works. I mean, I think the Lowy family thought it worked in Australia, so they were going to bring it over to the U.S. I think it's just one of those things that I don't think the consumer really cares, because they're not shopping all over the United States. They're shopping their community for the most part. So
Do you think the marketing efforts have to always be localized?
I think so. I think it's much more important to do that. I think, if you're a Macerich Mall on the West Coast, maybe it has a little bit of relevance, but GGP in Westfield, I don't think it means really anything. I mean, that's my personal, Peter Lowy would throw things at me if I said that, but I just haven't seen that work. So how do we eliminate sameness, which is one of the things that we work really hard on? We try to diversify the shops. We try to create districts. I mean, that's something that's very important. So we want to make sure that there's a district for, we'll call it teen apparel. So American Eagle and Aeropostale and Abercrombie do really well together. H&M would do pretty well in that group as well. We would try to put Coach with K Jewelers and the tenants like that. We try to put restaurants together. Restaurants are great, when they all mix together. Please.
On the point about restaurants, you mentioned earlier that restaurants create a lot of synergy, but one thing you hear a lot is how just volatile the restaurant business is. So how are you evaluating new restaurants, their credit, their potential to stay?
Carefully. It's kind of a one-off situation. I mean, certainly, if you got a TGI Fridays and it's a corporate store, you feel great about that. If you get Bonefish and it's a corporate store, that's great. When you start to get franchises, you got to look at the franchisee, how well they're capitalized. We try to think very carefully about the uses, so we have a good mix. So we've got, you know, the good kind of tavern, we've got a good burger place, a steakhouse, seafood, Mexican, depending on, you know, where you are, what kind of mix is really in need. So we're real thoughtful about that, and then we look at the credit, and sometimes we'll take a flyer on a local guy that has a really good operation we think is going to be super additive to our project. We'll reach out to that person and we'll look at giving them probably extra dollars in tenant improvements, and we'll look for a higher percentage rent contribution. So if the property does well, the restaurant does well, we become almost like a partner and we start participating in the upside. So there's really no formulaic way to look at it, but we do look at kind of use, type, and credit. I mean, all that kind of goes into the mix.
You mentioned JCPenney's own real estate assets before. Does
Yeah.
it seem to you like retailers are becoming more aggressive or intelligent about unlocking the value in their real estate assets?
I think you will absolutely see a lot more of that. I think Sears is really on the vanguard of this right now. They're starting to carve off pieces of their buildings. I mean, they've got gigantic buildings, 250 to 350,000 square feet, and they need about 150. And so they're looking at carving off corners and leasing them to Whole Foods or leasing them to Dick's Sporting Goods.
REIT spin-offs.
Sorry?
REIT spin-offs?
REIT spin-offs meaning?
I know like a brochure, like Loblaw in Canada, or at least they're talking about spinning their real estate assets off into a REIT.
Yeah.
Is that something?
Well, I mean, if you follow what Ackman's been trying to do with Pennies, I mean, that's one of his strategies is to actually do that, take the real estate owned and do exactly that. He had a brilliant dissertation that it was done a little while ago on YouTube. You can find it where he proposed at Target to basically take their real estate and spin it off into a different class. And he was soundly defeated, but brilliant idea. I don't know why they didn't do it. You had a question back there?
With respect to customer service, I have a question. Like, with the retail spaces and almost all the retailers are shrinking the spaces down and the malls becoming more lifestyle centers, how is it affecting the profits in terms of leases based on like fixed rents, or is it more on sales basis as well? Like, how do you maintain that balance?
So there's a question really, how you got shrinking retailers, right? And how's that maintaining the profitability of the mall or the retailer?
The mall, because you are also, like a lot of the leases are also based on the sales as well.
Yeah, it's a big problem. I mean, most of the malls in the United States were built in the 60s, 70s, and 80s. That's by far the vast majority, and that's when retailers were a lot bigger than they are today. And the depth of the space that they utilized were 200 and 250 feet in depth. Today, a retailer in ideal space depth is around 90 feet, 80 to 90 feet. So that's a lot of depth that you're not utilizing. And retailers are, in general, getting smaller. There's only a handful of guys like H&M and XXI that are taking a lot of bigger space. So it's a problem to figure out how that configuration will work within the existing confines of a mall. And you got to be really creative. One of the things that is enabling us to do is on the older malls that do have these tremendous depths, we're able to, a couple times we've been able to chop it off at the 80 to 90 foot basis and literally punch out the front of the mall and create an equal depth with an outward facing store. So you have kind of a two-sided program. You can't do that all the time. It works sometimes, but it's kind of one way to get around the issue. Let's see. So, I mean, a couple of the other key pieces here is safety. That is one of the real keys. I mean, you have a mall shooting, that's very bad for business. I mean, it stops shopping right away. You want it clean, and you don't want just a little bit of dirt. You want these things to be spotless. I mean, you've all been to malls. I mean, how many times have you gone into a mall restroom and gone, oh my God, this is disgusting? I mean, we spend a ton of money on redoing the restrooms. On average, if there's 2 sets of restrooms in a 1 million square foot mall, we spend $2 million. $1 million per restroom set. It's a lot of money. We gut them. We create really comfortable, very nice men's and women's room, a family lounge area, a nursing station. I mean, we really do it nicely. So if you're a customer, you have to use the restroom, you've got a nice experience, it's spotlessly clean. The other thing we do is we create these nice kind of living room, soft seating areas throughout the mall. I mean, the malls are big. People get tired. And you see a lot of couples shopping, and a lot of times the guys are done and they want to sit down. And one of the things we've tried to do is create a little bit of in the common area, a daddy daycare, we called it, where we just create a flat screen TV. You got a nice couple of comfortable couches, and you can just plant yourself and say, see you dear. And it's fixed to ESPN. So that's actually gone pretty well. You know, one of the other simple things is just making sure you can find your way around a property. I mean, how many times you've pulled into a mall and go, I want to go to this store, where the hell is it? And just having easy wayfinding is pretty basic, and it really makes a big difference. Parking is a service, so you want to make sure it's easy. One of the things that we've tried to do is implement valet service, especially when you have a theater. The department stores tend not to like the theaters because it kills parking on when you have a big movie going on. So one of the things we've tried to do, especially where you're integrating a theater with a bunch of restaurants, because that's very synergistic, that can be a big issue, and having a valet drop-off and pickup is a really good amenity to have. So when we work with groups, one of the things that we try to do here is set up a simple process of what's our vision.
How often is valet service used? Because I've seen those offered at some of the upscale malls, but I've never seen anyone use them except for maybe like a handful. They could just be me personally.
It's getting to be utilized more and more. I mean, our properties are starting to offer it, especially if they've got a theater. So we're definitely rolling that out there.
I come from Mexico, and all the malls, well, not all the malls, but a lot of malls now in Mexico are starting to charge for parking. It doesn't matter what type of mall it is, if it is high-end or not, but basically all kinds of malls are charging, and it hasn't had a negative experience, a negative result. Maybe, I don't know, but they are loaded. Do you see any trend similar here in the U.S.?
I would love to be able to charge parking, and I can't. Westfield's been able to do it at like Century City Mall in LA. I mean, you can charge a couple bucks, but it's tough to do that. I mean, unless it's a really urban location, you can't get away with it. And I don't see the average consumer willing to even pay $1. I mean, they're just not going to do it. So it's unique. But you know, as far as back to our approach as being an operating partner, and again, this is from an operating partner's perspective, we need to develop an asset plan. We need to articulate what that asset plan and vision is. We have an implementation program. We have partners that are very demanding. You know, it's some smart money out there, KKR, Square Mile. I mean, these guys are, you know, they're best in class money partners, but they're very demanding, and they expect, you know, very active communication. They are very hands-on. They want to know how their money is doing on a daily basis practically, and they want to have a finite way to measure progress. And a lot of that is leasing, but a lot of the, you know, the bottom line is the bottom line. But data is a big key to this. You know, we're looking for a very comprehensive feasibility deck that we prepare. We go out and hire very good marketing people initially to help us with this. And one of the, as I just touched on before, one of the key things is figuring out the void analysis. We do that up front. Certain parts of the country are more over retailed than others, and we need to figure out, do we have a universe of retailers that we can approach and that we can talk to and bring into the project? So it just, it depends. But we want to figure out who's not in the market, that's key, and who is overlapping on competing projects that we could potentially steal away. And we want to know, who's going to be appropriate here. Please.
Just trying to understand your role as operating partner when you acquire new properties, say for example with your capital partners such as KKR. Could you walk us through the process in the sense like what you are doing and what your capital partners are doing and how you are coming together with the understanding that this is the property you want to go ahead?
Yeah, I think I get to that here. Yeah, we'll skip through that. All right, so here's some of our tactics here. But what we tend to do is we'll find the asset. So we'll source a deal. We'll do kind of our preliminary metrics to see if this, fits our internal investment thesis, and then we try to we have to match that up with the capital. It's a bit daunting because it's hard enough to find an asset that you feel you can make money on and let alone be able to buy. And then once you get to the point where you're close to the threshold of buying, you have to match it up with the right capital. Because you can't just go tie up a piece of real estate. I mean, our balance sheet is not a KKR balance sheet, so when I go to a hypo bank, I need to show 150 million in cash in the bank. I don't have that. I'd love to have that, but I don't have that. But you've got to be able to show the seller the money, or otherwise you don't get to play. So you have to kind of have this all lined up before you make your final bid. And you've got to be able to articulate this vision, articulate the investment thesis that lines up with what their return expectations are. And there's a fairly good cross-section of return expectations. There's the core buyers, there's, I'll call it the value add plus guys. There's the value add and the opportunistic. And there's a different risk profile for each one of those. We're playing in the value add plus to maybe call it the core plus side. It's a little scarier when you get down the food chain on the riskier stuff right now. So you've got to have kind of those ducks in a row before you can really end up with the asset. And all these pieces have to kind of go together when you're making that investment thesis case. So again, our differentiation is focusing a lot on leasing. Development and design are key. Food, you just can't underestimate that. It's a huge attraction, and you want to have diversity in the price and the type and the experience. You want to have some compelling attractions. We had a mall that we owned in Maui, which was the only enclosed mall in Maui. And it was a great asset. We added a play area. It was the only play area in the Hawaiian Islands. And Maui doesn't have a huge resident population, only about 125,000 people, but it has over 2 million visitors a year. And we couldn't believe the success of that play area. And it was nothing too crazy, but it was something unique, and it was very different for the marketplace, and it was really well embraced by the customers. Keep going here. Marketing. I mean, marketing, as I touched on before, is a key aspect of ownership. You budget anywhere from $400,000 to $600,000 a year as an average marketing budget for one of these properties. You have to be smart on how you spend it. You don't spend it on TV. You rarely spend it on radio. You try to do the right print. You try to do the right direct mailers, and you try to be thoughtful about when you spend this money. But the marketing program supports leasing. It keeps you top of mind in the trade area, and that's kind of the whole thing, is you want to make sure that your trade area is not forgetting about you. Your trade area is aware of what you're doing on a regular basis.
How do you think online retailing and mobile apps are impacting malls in the
marketing or?
Yeah, I mean, that's a real complicated question. I mean, online retail is definitely impacting the malls, the bricks and mortars, but in certain categories. If you have an electronics, if you have books, you're getting killed by electronic retailing. If you're shopping for apparel, not so much. They're actually finding in the business right now that if you buy apparel online, there's a 50% chance that you will come back to the store because you didn't like the color, you didn't like the size, it just wasn't what you thought. And the ability to transfer that into additional sales is extremely high. You have a chance of really getting a customer, if they come back in for an exchange, to buy something. People do like to go in and touch and feel and figure out what it is they want. There is a problem though, you know, you go and you figure out exactly what you want, the right size, the right color, and then you go buy it online. That's becoming a bigger problem. Now, how that ends up sorting itself out, we don't know, but it's something that we're keeping a watchful eye on. Now, the positive side of the, you know, of the internet shopping and apps is that, you know, whether it's a Groupon or it's an ability to advertise a discrete sale, is pretty good. And if any of you have ever watched Minority Report, where Tom Cruise is walking in the mall and there's a retina scan, that's not too far off before they're able to, you know, pick out what's going on in your phone. I'm amazed this is legal, but it's something that you're going to see more and more implemented in the malls, that you can buy a system now that when a person walks into a mall, it starts tracking them via GPS. If you've got a GPS locator on your phone, it's tracking you. And it can track you where you go, how long you spend in a store, and you can really start seeing how your mall is working and integrating with your customer. And that knowledge is a lot of power. I mean, you can start figuring out, you know, how to contact that person, you know, the shopping trends of your customer. So you're going to see more of that get exploited, and you know, that could be of good benefit to the mall owners. I don't know about the customer so much, but it's it's good for the mall.
Going off of that last question, there's been an emergence of online websites like Rue La La and Guild and some of these other ones that are offering luxury goods at discounted prices. And one of the interesting facts is it's not just that they're offering low prices, but they're allowing customers to learn a little bit more about very specialty brands that might not be offered in retail stores. I'm curious, is this a trend that you're concerned about, or is this really such a small niche of the population that are focused on?
Well, it's really aspirational, right? So, I mean, if you're wealthy and you're going out for a Louis Vuitton bag or your Hermes, you're going to go to those stores because it's more than just buying that product. It's that whole experience. I mean, those are luxurious stores. It's an experience to go buy that stuff. If you just want a bag because you want the bag and you want the best price, yeah, those can be really helpful. So it just depends. I'm looking at the time. I'm going to go through some of this pretty quickly here. You know, again, we always want to stay within a budget within the partner. I can say that KKR doesn't want to go do a $100 million redevelopment no matter what. I mean, but they do want to do some good redevelopment work that's appropriate and in context with the buy that we made. You know, we're looking at executing effective strategies for the asset that, you know, meet the needs of the trade area. You know, we've touched about most of this. I mean, food court's another area that works in most malls, but not all malls. In some locations, food courts you don't really need. It's better just to maybe sprinkle the food around the mall and leave it at that. We find when there is a really good daytime workforce, so there's a good daytime population, food courts can be terrific. The mall that we just bought in Chicago has got about 180,000 people within a 5-minute drive time during the day. Big workforce. We're doubling the size of the food court. and we think that's going to be a real, good add for us. Money in the specialty leasing area, the ubiquitous carts and kiosks, vending programs, sponsorship. It's shocking how much money you can make in this area. Advertising and the sponsorship right now, a sponsorship for a play area. We happen to be close to a big hospital in Chicago. A good play area costs around $400,000 to add. We're getting the hospital to pay for it. Now that's great, man, because you can get that sort of kind of freebie to the property. Advertising, Westfield's been brilliant at it. If any of you are out in Los Angeles, in Culver City, there's a property that is called Culver City Mall. It used to be called Fox Hills. Fox Hills was known for its gang violence and shootings that used to exist out there. They totally remade the mall, and they put in Target, they added a lifestyle component, and they added these giant banners that are just on the edge of legality as far as the city codes are concerned, but they got away with them. And those banners, one side is getting $20,000 a month, and they have about 15. So that's a lot of extra revenue that they're getting off of these things. Expense control, we talked a little bit about this. I mean, CAMs, the common area maintenance cost, we really look to control that, because if the tenants are paying a lot of money in CAM, they can't pay rent. And retailers look at a gross cost. And one of the things that is a rule of thumb, on a typical mall that's doing around $350 to $450 a square foot, a retailer can pay 15% of their total sales in expenses, including rent. So we look at occupancy cost when we go into these assets, and we want to see how high that is. Now, if the occupancy cost is up over 15%, then we got a problem. We got to figure out how we're going to lower rents, how we're going to lower CAMs before we can raise rents again. So to the extent we can get a lower occupancy cost going in, then we have more maneuverability to raise rents. Taxes you try to keep as low as possible. Simple. Insurance and other non-recoverables, obviously you try to save on those. Get into the first case study. This is a project that is in Houston, Texas. I bought this when I was with Samara in 2003. We paid $58 million for it. It did not look like this. We dumped $20 million into it. We put in new floors. We had this kind of funky superstructure that was up on the ceiling, and we covered it up with drywall, and that's not wood, it's just drywall that looks like wood. And added kind of a ranch theme. We added a fireplace in the food court. The food court, having a fireplace was kind of unique in Houston because it's pretty bloody hot in the summertime. But it was a nice little amenity feature. You can see that it's located out here. I'm going to grab my... My assistant will be so happy I use this. But downtown's here. You got the Galleria, which is kind of the nicest part of town. And we're located right out on Highway 6. There's a big park right here. So the trade area kind of went like this. It was kind of an oval shape. And you can see it right there. But it was on Westheimer. Westheimer is a major arterial. The 10 is the major highway there. So here's the property here. It's about 100 acres. Westheimer's here, Highway 6, and this big Barker Reservoir is right here. The property has Macy's, which did pretty well at $30 million. It has Sears that was doing about $15 million. Dillard's doing about the same. A former Mervyn's department store, which was vacant, and it had JCPenney, which I mentioned to you before. So you can see kind of how it lays out here. So when we bought it, well, it was originally built by J&B in 1984. It had Lord & Taylor, Mervyn, Saks, Foley's, which became Macy's. It had an interesting evolution. one of my old companies, TCW, we did a convertible participating mortgage on this, which basically wiped out the equity, JMB's equity when there was a downturn. It's around 1,000,001 square feet, some pretty good sized boxes. It had an Alamo sixplex, which was kind of a funky little local theater. And it has a lot of retail around it, so it had a good regional base to it, so, which is something you certainly look for. Big trade area, 360,000 people, and growth of 14% over 5 years. Growth is great. I mean, if you miss on your investment thesis, growth will get you out of a lot of problems. Good household income, 88,000. In the energy corridor of Houston, which was a lot of daytime population, 10 miles away for the nearest competition, and that's a pretty decent distance. Good traffic counts. Strong anchor sales, I would say Macy's had good sales, and that's about it. And there was a lot of voids in the market. So you can see here's our trade area that was kind of an interesting polygon here. A lot of money going out in the Cinco Ranch area, no malls, and lots of very nice households. This is, I just put this up here because this is the type of stuff that we'll look at. We'll hire out to get this sort of review. So we're going to look at 1, 3, 5, and 10 mile radiuses just to kind of see what our population looks like. And we'll compare that to generally the county and the city. And then it's always good to have a little bit of a benchmark on the US and Texas. We'll also look at household incomes. Red is the money. We're right here. Obviously there's a park here. Definitely this was not the best part of Houston that was close by, so we wanted to attract more of this and a lot more of this. And you can see the population densities. Again, this is just more illustrative of some of the stuff that we look at. I put this in here just so I could show you what psychographics look like. I mean, there's a lot of really good reports you can get out there, and they've got some kind of goofy names, but it really gives you a good idea of kind of the demographic makeup. And these demographic makeups really tell you a lot about who's shopping and who you should get for a retailer. The executive suites, country squires, the blue bloods, these are great. Those are the guys with a lot of money. So first acquisition, bought this in '03 for $58 million. It was about a 9.5 cap. We spent $20 million on renovating it. We were pretty happy with it and sold it in 2005. We sold it to this guy, Ed Oken. And Ed was not a good guy. We knew he wasn't a good guy when we sold it to him, but he had that number, which was a really good offer for us. And we said, okay, Ed, if you can basically perform in 2 weeks, we'll sell it to you. And he did. And as soon as he acquired it, he put a ton of debt. I mean, on a $102 million price, I think he put about $114 million of debt on it. And he did it through a tenant in common program where he has lots of, basically a syndication. And he turned around and defrauded his various ticks, not just this, but a whole bunch of others. And plus this guy, goofy guy from Miami, decided to buy a couple jets, had a few really large yachts, and had a very ostentatious lifestyle. The mall really suffered. I mean, we had some great tenants in there, and we had really kind of moved the NOI significantly, and it was on its way to get to $8 million pretty quickly. Tenants were literally having their leases expire and saying, we'd like to renew, and nobody would call them back. So you had a very absentee criminal ownership. He had the good fortune of defrauding his ticks, property going into bankruptcy, and going in front of a judge right after Bernie Madoff did, and literally he got 100 years. And Ed's in jail for quite a while. It went into foreclosure, Greenwich Capital Loan origination. HFF brought it to market in '09. We looked at it, and the NOI had gotten crushed. I mean, So I think I've mentioned this business is not for the faint of heart. You can definitely have a tipping point and watch your mall fall off a cliff pretty quickly. But this was 2009. This was a very dark time to be in the real estate business. And the servicer, the special servicer for CMBS debt, didn't want this loan. They wanted out. We had basically a good partner with Square Mile, who was a hedge fund. They were looking for value. And they thought, how bad could it be at $15 million? And we kind of agreed, even though it was a $2.5 million NOI, you could see some scenarios that this was going to go to zero. And so we were happy we got it at this. I remember buying it and closing and going, oh my God, what did we just do? And but we've turned this thing around, and we have started a redevelopment where we created a hybrid, and we tore down some of the pieces to it and implemented an entertainment precinct. As you can see, what we had existing, and we tore down roughly 160,000 square feet. We added a new Regal 14-plex. We're in talks with a couple of the local grocery stores. We're adding, I hope, 7 restaurants. We've got 3 that are leased right now, and we're adding some new outside retail. It'll maintain basically the same overall GLA. We've started the process. We've had Regal is opened. They call it Edwards there. That's kind of their upscale version. A couple restaurants on the side. Very nice plaza with fountains. This is what it was. This area is basically from this portion back. We tore all this down. And here's the new scheme. The Alamo Cinema space, we thought this was going to be one of the last pieces to lease because it's 26,000 square feet and it's an old theater. What are you going to do with it? We just signed a lease and we're opening next month with Toby Keith. I love this bar. You like country western and the home of the deep fried Twinkie. They will be here. So we're pretty excited about that. Regal's doing very well. We got a bunch of restaurants that are going in here. This is where the old JCPenney is. We're going to have the technical school go on the second floor. But we're very happy with this. We think it's a really nice look, and it's something different for the trade area.
How do you manage that redevelopment process with your existing tenants? It seems like it can be very...
Well, we vacated it. We vacated that whole wing. That wing was particularly weak. I mean, we didn't have an anchor. There's only a handful of tenants, and we just basically either relocated or just got rid of those tenants over time.
But in general, like when you have a mall that you're going to do a full-on redevelopment for, what's kind of, I mean, because obviously it impacts traffic flow if you're doing...
Oh, yeah. I mean, especially... to do a floor in a mall, I mean, it's an expensive proposition. It's over $1 million, and you have to do it at night. Tenants are not happy about the dust and so forth, and you just have to communicate with them. 9 out of 10 tenants are going to work with you because they know that you're improving the venue, and you're going to overall make the mall a better place. So they'll work with you. So but it's a lot of communication. It's a lot of marketing effort to do that.
You don't have to get concessions during that time. Is that ever?
Sometimes.
Okay.
Sometimes. I mean, you try not to, but you can find some sticklers that'll make it tough for you. So, and this is an actual photo of what it looks like. So it's kind of neat that Callison Architects did this for us. That it actually looks the way it was drawn. It's kind of a neat concept. We got time, I think, to go through this. This is a project we bought with KKR in Chicago called Yorktown Mall. Interesting property built by the Godfather.